Hello, everyone. Welcome to this session on systematic investing of our speaker series, The Future of Finance. So I'm Laurent Deville. I'm the academic director of the Masters in Finance at EDHEC Business School. And today, in the absence of its regular host, Emmanuel Jorzenko, I will serve as interim for the Future of Finance speaker series. So I have the real pleasure of welcoming Nick Baltas, Managing Director and Head of R&D, Cross-Asset Delta One and Commodity Systematic Trading Strategies at Goldman Sachs. With us today, we have Nikolaos Tesaromatis, Professor of Finance at EDHEC Business School, and Yunyu Zhang, one of our amazing students from the MSc in Financial Engineering. Thanks a lot for being here with us today as moderators of the Q&A session. So I'm going to start with a few words on Nick, and he told me that I shouldn't be too long because he has a lot to share with us. So Nick is specifically responsible for advising on factor and risk premium investing, portfolio construction, and strategy design at Goldman Sachs. I'm not going to discuss Nick's outstanding career and contributions, or there would be no time for his speech on systematic investing, and I know this is the reason you are here with us today. Yet, before I leave the floor to him, I would like to mention that Nick stands on the frontier between academia and industry. He has a foot in the industry at Goldman Sachs and a foot in academia at Imperial College Business School in London. And this is something we highly value at EDHEC Business School. And I think this makes his contribution to this speaker series, The Future of Finance, all the more relevant. So with further ado, Nick, I would like to leave you the floor and, well, let you speak about systematic investing for the next 35 minutes.
Thank you so much, Laurent, and good afternoon, everyone. I'm very, very happy to be here. I've been knowing Emmanuel actually for years, and it's a pleasure to be here, even at his absence. I think Laurent would possibly be even better than Emmanuel on this role. So happy to be here with you. I'm going to go through some of the latest ideas with regards to how we look into systematic investing, in the world of I guess global asset allocation. I can share some of my own views and possibly give some sort of feedback as to what we're seeing these days with with investors. Obviously, the market is going through some turbulent kind of dynamics. Depends how you define turbulent, but certainly not a calm period by all means. I've spent the last 10 weeks, traveling across the globe, speaking to asset owners, asset managers, insurance companies, basically getting their views of the current market environment, but also trying to help out on how we should be thinking about asset allocation with a systematic, if you like, angle into it. A very, very brief kind of background, and again, I kind of dislike kind of long-term introductions, but just for the benefit of this group, I'm an engineer by training, and I've done engineering in my early days, computer engineering back in Athens. I'm Greek, and then I followed through a path of masters in engineering, and then a PhD in financial economics at Imperial College. Spent some time as an academic, then went to UBS for a number of years, being a quantitative researcher, and now at Goldman Sachs. My primary focus is to do, if you like, high-level research on systematic investing themes, but also spending my days looking into cross-asset as well as commodity systematic strategies. I can go into more details, but that's a very brief kind of overview. So there's certainly an engineering kind of mindset in anything I try to do and however I try to apply it. So for today, I should possibly just start sharing my screen on a presentation I have prepared. What I wanted to kind of go through, can you actually see okay, or should I just make the window? Does that look good, or should I just?
If you can put it full screen, that would be perfect.
Let me try in full screen, and let me hope no Bloomberg chats will appear in front. Okay, there you are. So, what I wanted to basically discuss today is, how the recent dynamics around specifically inflation have substantially changed the way that we see investors doing strategic asset allocation, but also looking into a systematic toolkit to solve for specific objectives. When I talk about systematic toolkit and I'm talking about systematic strategies, all I'm actually talking about is, looking into an asset class and trying to build a set of rules that allow us to codify an investment strategy and let it run without any human intervention. From a very basic, the most basic, if you like, systematic strategy is, I don't know, S&P 500. It basically says, on a regular basis, let's call it every quarter, I'm going to look into the market capitalization of all the stocks that are traded in the US. I'm going to pick the largest 500, and I'm going to allocate $100 in proportions that reflect their respective market capitalization. So if one stock is like 2 times larger than another, it's going to get 2 times the weight out of $100. This is by itself a systematic strategy, purely because it follows some rules. And in perpetuity, it keeps on ticking in our Bloomberg screens, without necessarily us having to do anything with it. In that context, we can codify things like, I don't know, equity momentum. One of the simplest investment strategies in the single stock space. Every month or every quarter or every week, find the best strategy, the best stocks, go long those, find the worst stocks, go short those, and keep on doing that on a regular basis. This is nothing more than building a systematic strategy that only has human input at the design phase, a lot of robustness checks, but post that, you end up having like a systematic strategy that is harvesting equity momentum. So in this regard, we can think of a number of systematic strategies. So now we're going to look into those through the lens of, of inflation dynamics. So let's give it a go. Last year was quite a year. And last year was quite a year because we have seen, possibly for the first time in decades, if not more, a significant sell-off between equities and bonds. Historically, equities and bonds have been negatively correlated. In other words, when equities are doing badly, bonds typically do well, typically because central banks intervene, and therefore the magic combination, or one of the more popular combinations in the, I guess, in the asset allocation space, has been to go 60% of your notional in equities and 40% of your notional in bonds. Now, when one does a job, the other one is going to do badly, and vice versa, unless both do badly. And that's exactly what happened last year on the back end of inflation concerns. I'll talk you through in the next slide. But if you look into the performance of this 60-40 portfolio that over the last many decades has been, the golden asset allocation model, very simplistic yet quite successful. You had a very significant underperformance. There was a bit of a reversion in November. This year is basically a flat line. This is effectively, that's I think yesterday actually. I updated the chart last night. So this case for last year was pretty problematic for all asset owners because their core exposure in equities and bonds did extremely badly. We're talking about losing about 20 to 25% with a 10% annualized volatility. This is pretty bad, right? Now, if you look into asset allocation in a slightly more, I guess, sophisticated way, then we have those so-called schemes of risk parity. This basically says, take your equities, your bonds, possibly some commodities, possibly some currencies, and allocate into those assets on an inverse volatility basis. There's very reasons why you should want to do this inverse volatility. Roughly speaking, you equate the risk exposure across the asset classes. But even if you were to do that, performance was basically the same. And then there's another kind of mindset in asset allocation that says, I'm going to build an all-weather portfolio, still going long assets from different asset classes, but I'm going to design the portfolio so somehow it is very well positioned no matter whichever inflation growth regime comes up. So if inflation is rising and growth is rising, or inflation is falling and growth is falling, no matter what happens, I have an umbrella, an all-weather allocation that is going to do the job. Not even that did the job. So basically last year, if you were to look through, and that's a chart I've been using for quite some time now and keep on updating it, if you look at those lines at the bottom, any asset allocation framework, no matter how simplistic, basic, or possibly sophisticated it has been, it did not do the job. Basically because the vast majority of assets underperformed. That was the key issue. No matter how many investments you have, if all of them are negative, any linear combination will be negative. So that's exactly what we're trying to showcase here. So in this regard, we want to highlight the need, and that's what I'm saying in the second bullet point. We want to highlight the need of starting being dynamic. And we can be dynamic in the asset selection. And one example that I'm showing you here with the orange line, and I'm going to talk you through that orange line in the rest of the presentation, is doing a dynamic asset allocation that has some sort of an all-weather dynamic embedded in it. So, if anything, it's not about doing commodities and equities and bonds and currencies, but it's more about dynamically selecting the assets through time and not always have everything in a balanced portfolio. So possibly last year was the first time we actually saw a prime example of diversification not always paying out. And obviously extending that dynamism, extending this dynamic asset allocation model and allowing ourselves to potentially go short. So shorting equities or shorting bonds or shorting currencies can allow us to even extend the concept of being dynamic on an allocation basis and now having long short allocations. And the prime example here is what we call a trend following strategy. There's a few other details here to make a strategy more defensive, but a trend following strategy basically says whatever goes up you buy, whatever goes down you sell. So by all means, last year when things were falling, you would be selling them. And therefore a trend following strategy had one of the best years on record because it was shorting equities, it was shorting rates, it was going long the dollar, so basically shorting all the global currencies. But long story short, as an introductory slide, the point that I want to make is that any asset allocation model has done pretty badly last year. Nothing in particular for this year. So this highlights potentially a significant shift because of inflation into more dynamic asset allocation models, even more so on the long short front. That's the top line. By the way, last week was a substantially difficult week for trend followers for reasons that I might have time to explain later on. But the interest rate moves we saw last week, were basically quite large by historical standards. So that's the intro. What can we do about asset allocation and how a systematic toolkit can help us out? Giving me a bit more context now with a more kind of an economics standpoint. Why do those 60-40 portfolios do well historically, and why did they not do well last year? That was my primary point. So what you see on the left-hand side is the following chart. I have the rolling 1 year equity bond correlation, and then on the x-axis I have a 5-year inflation. Right. So all I'm saying is that how do equities and bonds correlate as a function of the contemporaneous inflation? There's no causality argument. This is purely coincidental. So the point that we want to make here is the following. If equities and bonds are negatively correlated, so you're somewhere here in the bottom, do you actually see my mouse when I'm moving it or not? Yes, you can see. Okay, perfect. So when you are with a negative equity bond correlation, it means that when equities go up, bonds might fall, or when equities fall, bonds go up. So the combo of the two kind of does the job. It's a diversified combo, even if too simplistic. But if the correlation starts being positive, well, when both go up, happy days, but reality both go down. And that's the problem, right? When the correlation between the two turns to be positive, it typically gets positive when both tank. And that's the primary concern that we saw last year. So what do you say here? Basically, is that when inflation is relatively tamed and low around the target or below of the central banks, the correlation is negative. Equities and bonds are negatively correlated, so the combo of the two is well diversified. When inflation rises, and by all means, that's exactly where we've been since the beginning of last year, you have this positive correlation between the two, with both of them typically tanking as opposed to both going up, right? Another way of looking into it, we can look here into inflation dynamics, with low inflation first row, medium inflation, and high inflation, whereby growth is low or medium or high. And then we look into the performance of a 60-40 portfolio, right? Now, precisely my point was that when inflation is low, a 60-40 portfolio does well, irrespective of the growth. But when it becomes more challenging is when inflation rises quite dramatically, and then irrespective of growth, you end up having significant underperformance, specifically when you have the so-called stagflation regime, whereby inflation is rising, but then growth is kind of falling. That's the toughest period. This is basically data from the 1900s. So that's like 120 years of data. There's reasons why those kind of relationships exist with equity bond correlation. I know in the interest of time, I'm not going to go through those, but happy to go through. The point being, inflation and growth dynamics are related to the performance of 60/40 portfolios precisely because they interact with the way that those two asset classes interact with each other. So the correlation dynamics is the one that primarily caused this downturn, right? So that's the motivation. So let's move on. Let's move on by showing you a kind of a cool chart. This is a chart we did about a year ago, and ever since then, I've been updating it. I must say that I haven't updated recently, but the path doesn't change. So if you remember what happened post-COVID, the inflation story did not really pick up instantaneously. What happened was a year after COVID, in the first anniversary, that's the gray bar. This is the second quarter of 2021. That's a year after COVID. Inflation started picking up primarily because of what we call base effects. So there were no transactions during COVID. The quoted prices had fallen. And obviously a year after, when you compare the prices to artificial prices a year back, it looks as if the prices have gone up in a way. That's the base effect. So your base was low, so the year-on-year changes would look high. But then people were talking about, hey, it's a base effect, so it's what we call transitory inflation. What happened was, however, that over the summer, the interest had fallen on transitory inflation and then picked up again in Q4 2021 up until just before December in 2021. The Fed chair Powell came out and said, it's not anymore transitory, inflation is here to stay, we basically have to counterfight it. Now, why is this chart a cool chart? Because all I've done is that I went to Google Trends. I'm not sure if you know what Google Trends is. I'm going to take like a second to explain what that is. You go to Google, you ask Google, how many people have they looked for inflation? How many people have they looked for transitory inflation? And basically Google nicely draws some charts. You can download the data, you can plot it yourselves. You don't get the actual number of the searches. What you actually get is a graph whereby its historical maximum is mapped at 100 and everything else scales accordingly. So it's effectively a normalized intensity of the searches. And it's quite nice to just go to Google and ask for transitory inflation or inflation and look at a chart that pretty much maps exactly what our view was, or if you like, our perception from speaking to investors, that inflation had picked up a lot in Q2 2021 as a consequence of the base effect. Then people kind of forgot during the summer, and then when September 2021 came with some significant rate rises, inflation got back into the game. So this transitory inflation, made people panic. They started Googling about it, started obviously debating about it, and the consequence of all that was that this debate kept on being the trend up until it wasn't, and then inflation dominated once we dealt with this debate. So that's kind of the debate that faded that I'm kind of saying in the beginning. So kind of going in the beginning, very challenging here. Inflation is at the core of this thing. Inflation went through a debate whereby investors were debating between if it's here to stay or not here to stay. It is obviously here to stay, and then the question is what we do about it. So what do we do about it? We wanted to basically go back in time and understand how asset classes interact with inflation and growth dynamics. So measuring inflation is extremely challenging. I'm not an economist myself, so you can challenge me all you like. But reality is, when it comes to inflation, you can go back and estimate inflation as the year-on-year change, for example, in a price index. Now, there's a CPI or the PC, which is more like it's more like the growth trend of prices, or the UIG, which is like another proxy of core inflation. But there are a number of price indices which we can use to define year-on-year changes. But then you have the forward-looking measures. Okay, what is my expected inflation? But the expected inflation also has like a number of options. You can look into models. So some of the central banks are running models to predict inflation. Others use surveys. So we go around and ask people, okay, what do you expect inflation to be like in a year? We have even more data coming from what we call the implied inflation from what we call the TIPS market. TIPS market is a fixed income market whereby the bonds you hold have their notional adjusted by how inflation is moving ahead. So if you buy a bond today for $100, in 20 years, those $100 wouldn't be anymore $100 with the same purchasing power. But having adjusted those $100 through the years by inflation at least your growth of capital would have grown together with inflation. So embedded in the pricing of those options, of those bonds, you have the inflation. So we can imply what we call the break-even inflation from that market. Anyway, long story short being that even on a forward-looking basis, we have too many options. And the reality is the correlation between those measures is not very high. So which one do we choose? And specifically, if we want to use those metrics and define regimes of inflation, you have another problem because inflation has this anchoring to this value of 2%. Like we are anchored on this 2%, which by the way, has not been determined by by any scientific analysis, I think, and I could be wrong, but I think it was a former finance minister from New Zealand that mentioned 2% in a TV show, I think a few decades back, and that's the reason why the 2% is the 2%. Anyway, that's kind of the anecdote of the day. But when we want to define regimes, if inflation is rising from 0 to 0.5, it's not a big deal. The problem is when it crosses a problematic threshold. So once we start looking into regimes, do we look into the level that inflation is, like low, moderate, or high, as we actually looked here? Or is it more about the change in the inflation? So is it going up or is it going down or is it like stable? But even the change itself, which change? Is it like the realized change, the realized inflation today versus like last month or like a quarter back? Or is it the realized inflation today based on what I forecasted a year ago? So there's so many moving parts here, and defining inflation regimes is not the easiest thing. But anyway, we had to define some regimes for inflation and growth. So what we did for inflation goes as follows. I'll go in the bottom here. So we want to find regimes whereby inflation has been rising. And I'll just paint the, I guess, the picture for you without necessarily spending too much time on the actual definitions. Basically, we want to have two things happening at the same time for us to be worried about inflation. We want the inflation change month on month to increase, so we have a spike in inflation, but the actual level of inflation to be above a problematic threshold. We're using 2.5%. That's not really the detail here. The point being, if inflation is rising and the actual level is above some problematic threshold, that's a rising inflation regime. Anything else is, strictly speaking, not rising. I wouldn't call it falling, because reality is if inflation goes again from 0 to 0.5, it is still called in our framework a falling regression, falling inflation. So this is, if both the level and the change are positive, it's rising. Otherwise, it's negative, right? Now, that's the inflation dynamic. The growth dynamic would basically look into some economic indicator, some leading economic indicator. We use one of those. You can think of economic indicators, specifically leading ones, as a combination of like macro data, I don't know, PMIs and production data and new orders, price data, some spreads, volatility, and so on and so forth. The aggregation of those measures giving you some indication of where the economic activity is. So then month-on-month changes with some smoothing, kind of bypassing some technical details here, would give us a good growth scenario. Otherwise, it's a bad growth scenario. And then obviously, if you have rising growth, rising inflation, falling inflation, you bring them together, and then you have like 4 regimes. And these are outlined at the bottom for the last 50 plus years, both rising, both falling, growth rising, inflation falling, and vice versa. And what you see here, not a big surprise, the dominant regime over the last 50 years has been rising growth, falling inflation. So when growth is rising, equities do well. When inflation is falling, typically nominal yields are falling, so bonds are doing well, so equities and bonds are doing well, happy days. That's why 60-40 was doing well. The most problematic regime, and the least likely to have happened historically, is what we call the stagflation, falling growth and rising inflation. It happened mainly during the late 70s, early 80s, partly in the mid 2000s, but at that time we didn't feel it. And actually last summer, this is last summer. So last summer we had the most recent data point of falling growth and rising inflation. By the way, now we are in the falling growth, falling inflation. That's the latest data point. I think this chart is until November, but the regime is still the same until today. So we're still in the falling growth, falling inflation. So now that we have 50 years of I guess of characterization of regimes, we can do the following exercise. By the way, these are the regimes and how they they change through time. I'm not going to spend too much time. Actually, those gray boxes here shouldn't have appeared. It's more like I guess a conversion of PowerPoint into PDF. Anyway, forget about those gray boxes at the bottom. All I'm saying is that as of November, inflation was above a problematic level, but it was changing year on year. Sorry, month on month. So that's a falling inflation. That's why we're in a down inflation regime, and the growth signal was also like on the negative side. So growth is falling. So the combination of those suggests this falling growth, falling inflation. Anyway, I'm gonna pass on quickly through that. That's just looking through how those indicators suggest at each point in time what is the regime we're at. But this is now the analysis, which I think is the interesting part of the of the first part of this presentation. I think I have about another 10 minutes or so, give or take. Okay, super. So what we do here is the following. We basically take those 50 plus years. We have all those regimes that I highlighted, and then we have the major asset classes, namely equities, interest rates as in bonds, inflation-linked bonds. Don't worry too much about that. Credit, this is credit spreads. We're not looking into the duration element of credit. And then we have some commodities, precious metals, energy, industrials. And at the bottom, we have this classic 60-40 portfolio. And all we're saying is that, okay, go historically and try to understand how well or badly each one of those asset classes has done in each one of the specific regimes. How do you read this map? When you see a red box, you basically have a negative conditional performance in that particular regime. Example, when growth is falling and inflation is rising, equities have historically been down. That's how we read this table. Now, the positive one or the up boxes, so the green one, if I start with the with the green one, this is when a particular asset class has been performing in a specific regime more than its historical return. So what I'm saying at the bottom, it has a positive conditional return above the full sample return. So not only does it perform well, but it performs well above and beyond the average return. So when growth is rising and inflation is falling, equities not only do well, but they actually outperform their long-term performance. So that's really the regime they're doing well. And when you see this yellow, it's more about having a positive return, but at the same time below the unconditional return. So it's okay, but it's not like great in a way. And to give you a few examples, let's go to the 60-40 as I mentioned. Historically, with the growth up, inflation down, it was the best. That's exactly what I mentioned. For years and years and years, we have had this regime. People in the industry call it the Goldilocks regime. But last summer, that was the challenging part. We had the falling growth, rising inflation, that part, right? And in the beginning of the year, we had rising inflation, as in last year, rising inflation, rising growth, which can be okay, but not great. So putting together this type of information at the bottom kind of confirms the initial statements on how 60-40 allocations have performed over the last 13 months or so, 15 months. Now, by the way, there's a number of things that, if you go through each and every asset class and each and every regime kind of makes sense. I'll give you one example. People talk about commodities with inflationary regimes, and they say, well, inflation will help commodities do well, or commodities do well in inflationary regimes. I'm going to say it depends, because if we look into precious metals, energy, and industrials, yes, indeed, they all do well when inflation is rising together with growth. But when inflation is rising and the growth is falling, not all commodities do well. And typically, the industrial commodities, which are primarily growth oriented, you need your base metals to actually build cars, they wouldn't do well if the growth is low, right? So the inflationary dynamic plays out primarily with precious metals and energy. So I think this intersection of growth and inflation is very important to look into. Now, what this allows us to do is to basically do conditional regime selection of asset classes and actually build on a vertical by vertical basis 4 portfolios, each of which is expected to perform better in a specific regime. Currently, we're in a falling growth, falling inflation. So currently, we will be holding bonds, what we call steepeners. If that is too much of a detail, leave it there, and gold. This combination last week was an extremely good combination, by the way. That was like, an out of sample data point that happened last week. So if you build those 4 portfolios, and these are risk allocations between the asset classes, you can then build what we call an all-weather portfolio by combining all those 4 portfolios in one portfolio. That portfolio would hold on your left-hand side the following asset classes, and the proportions you see here are, are in risk terms. But overall, a portfolio like that is what we call a regime-based portfolio. It's a portfolio that can do the job no matter what the regime is, right? So as opposed to having a 60-40, we can have this particular combination of asset classes to help us navigate through. But is that true? Because had we done this analysis, seemingly we should do better than the 60-40 portfolio that specifically in this growth down, inflation up regime does badly. Well, let's look at it. 4 regimes here, both up, both down, and so on and so forth. The problematic regime, historically, the performance of the 60-40 has been pretty bad. We built this kind of all-weather portfolio, this regime balance portfolio, and it now actually solves our problems. So happy days, but is it really happy days? Well, I guess the devil is in the details. It is seemingly all good unless you start scrutinizing the data and looking specifically for the most extreme historical, I guess, data points, which are, which are associated with an equity bond correlation move that has been very extreme and positive. So if you remember in the very beginning, when equities and bonds in their own correlation, if it spikes up, this is pretty bad. So if we now take historical data and we slice and dice the historical data by the correlation move on equities and bonds, and we go from the 0 to the 5th percentile, 5th to the 10th, and so on, up until the largest 5th percentile. So the most extreme equity bond correlation moves on the upside. So when the two become highly correlated, 2 things are happening. Either both are performing or both are going down. But I mentioned that already, 60-40 does badly. But not only that does badly, even a regime balance portfolio does badly. So there's some sort of fundamental, kind of systematic inflation-driven, equity bond correlation-driven risk in any form of asset allocation portfolios. And that's again the point that I was making in the beginning, that even in an all-weather portfolio like the one we just built, the red one, did badly last year. So this fundamental inflation-oriented and equity bond correlation dynamic did play out badly. So we need to do something about it. Laurent, do you have a question? I see you.
Not yet. I was about to say that you still have 5 minutes, and I would be very sorry to cut you in the middle of your speech. But if you can just try to summarize the remainder of your speech within the next 5 to 7 minutes, then we can have a discussion.
Hey, I'm fine. So what we can then do here is to basically motivate the dynamism, the dynamic allocation model. So here what we want to show is the following. If you take every one of those 4 portfolios we built and you try to find the performance it has had in each and every regime, you find something that kind of makes sense. The green one is the regime that the portfolio has been built for. So the both up portfolio outperforms in the target regime, happy days. But interestingly, every single portfolio is underperforming when the opposite regime comes. So you have a portfolio that targets rising growth, rising inflation. When falling growth, falling inflation comes out, it's doing pretty badly. So data point number 1, every portfolio does very badly in the opposing regime. Second data point here, if you are in a particular regime, as you go through the horizontals, what's the probability of even staying in the regime? That's the diagonal, of course, very high probability. But what's the probability of going into each and every other regime? The smallest probability is to basically go to the orthogonal regime. So if you're in the both down, to go in the both up, it's highly unlikely. And if you go through the numbers, crossing the diagonals in the 2x2 regime kind of combo is the least likely scenario. So here's the idea. You don't cross the regimes diagonally. Not only that, if you have a particular regime, the opposing portfolio does badly. So here's a nice Black-Liederman dynamic model that says, I have a balanced allocation across the 4 portfolios, and then I'm going to deploy some active weights that tell me overweight the regime you're at, underweight the regime you're very orthogonal to, and that's now a portfolio that has a dynamic element into it that allows you with some tracking error to the balanced allocation, be a bit more dynamic across. And that's basically the regimes at the bottom through time and the weights in the 4 portfolios as they move around through time. And kind of you see that the light orange eats up from the dark orange, the light blue eats up from the dark blue. So these are the orthogonal portfolios budgeting each other into this transition, right? I'll go through. I mean, I guess performance-wise, this is the dynamic portfolio that I showed you in the very beginning. That was the flat line. That's precisely the version that we see a good amount of appetite for, precisely because it allows itself to navigate through as the regimes change and ultimately achieving outperformance in each and every regime. This is again, just to kind of connect the dots, it's that portfolio in the middle. It's nothing more than the red, but you start being a bit more dynamic about the regime. You use the regime as an information context to tilt your exposures. I guess the last 2 minutes that I'm going to say, so that's the dynamic allocation. The last thing I'm going to say is there's one way to think about dynamism, that is, using economic indicators like inflation and growth. One other camp that we have seen a lot of interest for is those trend following strategies that basically say, well, I'm going to follow my past performance. If an asset is going up, I'm going to buy. If it's going down, I'm going to sell. It's another way of identifying the regime without calling it a regime. But if rates are going up and they're going to continue going up, let's basically buy bonds. I mean, when rates are going up, you sell bonds. If you were to be very strict with the terminology, those strategies historically have done pretty strongly around inflationary regimes. Here we have falling inflations and with surprises, high inflation with and without surprises. That's the performance of trend following since 1979. Kind of a U-shape, kind of does well when there is change, when there is uncertainty. Following those trends has historically benefited. And here, I think that's my second to last slide. This is the annual performance of trend following for every year since 2000. What you basically see is last year's extremely good performance. That's the blue line. It has been one of the best years, and actually one of the best years even in the last decade. The blue ones are the last decade, and the early decade is the pink. There are reasons why there are more blues here and more oranges on the top. I'll skip that, but happy to comment upon it. And the attribution of performance primarily came from rates, but here we're shorting rates last year. It came from commodities in the beginning, that's the light blue. We're going long commodities. It came from the dollar exposure in the summer. This comes from the fact that we're shorting all the currencies. So what I'm getting here is that a dynamic long-only asset allocation model, as the one I showed you before, can do the job, but now we're just extending that and we're moving away from just being long. We can be even short. So I think with that, I'll possibly just finish off. I had like this one slide here, basically talking about rising, falling growth, rising, falling, inflation, and how the various quadrants have different type of systematic exposures that can allow us to, to benefit. The one I basically talked about just now was this kind of defensive trend following or some form of trend following. There's so many other ideas here, but I think I'm gonna probably stop here. There's probably quite a lot. So thanks for the attention and happy to engage more.
Thank you very much, Nick. And I think we could have listened to you for an hour or more. But so let's move on to the discussion. And before I leave the floor to Nikos, I would like to ask a very simple question, a naive question. How long does it take before you realize that you have switched from one regime to the next? Because I think that's the perspective, is that you need a little bit of time to realize that things have changed, that the market has changed. Because if you trade on every day, then I guess the cost of rebalancing your portfolio is going to be crazy, and you're going to make errors. So you need some time before you realize that market has changed. And so how much time do you need?
Okay, yeah, that's a great question. So number one, I think you make the most important point here is that typically economic regimes don't change every month. No, there has to be some time to document a regime shift. Now, of course, this is not observable and will never be observable. So we're actually trying to estimate something that we cannot even confirm ourselves we are actually correct. The other extreme is to say I'm going to use a very long-term smoothed indicator that is going to flag a regime shift very late. Now, if we're super late in terms of identifying the regime, yeah, happy days. We possibly found that last year it was a recession, but by all means we are probably like broke. So here's the trade-off between I want to be reactive in my estimation and regime shifts, but equally, I want to somehow find a way to control my false positives. So what we do here, and by all means, that's not a panacea, but if anything, it's a way of doing it. We look into those monthly changes and we apply a 3-month exponentially weighted moving average to allow us to smooth out the historical changes by some amount before we claim that the change is positive or negative. Data point number one is that. So there's no right or wrong. We use a 3-month exponential weighted moving average. We can use one, and the graph at the bottom would be a bit more wiggly. If you like, a bit more noisy. Data point number 2, every time the regime shifts, when we build a dynamic portfolio that moves between one portfolio and another, what we tend to do is that we smooth the execution for a month. So we basically say, hey, you want to sell this portfolio, you want to buy this portfolio. Actually, what you want to do is sell 1/22 of the first portfolio every single day and buy 1/22 of the latter portfolio every single day. So over the course of the month, you smooth out the costs and you somehow transition. And not only that, you even allow yourself some buffer if the regime call that you made was incorrect. So yes, that's a very key question and on how we ultimately implement those strategies.
Okay, thank you very much, Nikolaos. I hope that I didn't step on your shoes, and so I leave you the floor to ask Nick questions now.
Thank you. No, not at all, Lohan. Thank you, Nick. Thank you very much for a very interesting presentation. Food for thought.
Pleasure.
On a subject that is very topical indeed. And let me ask a question about what you I mean, the reason, I suppose, for doing all this is what happened in last year, right, in 2022, which is at the same time we have falls in bonds and equities. Now, this is a very, if you look at history, it hasn't happened a lot. In fact, over the last 100 years, maybe there are only 3 years that we had this. So my question is this: in 31, 41, and then in 67,
exactly.
70. Exactly. So it's so my question is this: should we worry about this? I mean, is this something that we should worry us? What's the likelihood of this repeating? Any thoughts on that?
So I mean, in the absence of having a crystal ball, I think my comment would be that the tricky situation here is that we've been in this loophole of high inflation with central banks trying to tame it. But obviously, the issue is that the more we see central banks hiking, the more of a growth shock we're imposing in the economy. And the question is, how is it likely to tame inflation but avoid getting into a recession? Because the reality is, as long as this is achieved, and that was earlier in the year, what people were calling the soft landing scenario, if that is the case, then we can get into a space whereby inflation will fall to the 2, 3, 4%. Possibly some terminal rates will be at the 3% or so. But frankly, I do not see us kind of going back to the kind of the 0% interest rates and and equity prices kind of rising and central bank balance sheets ballooning. So why is it concerning? Because there are obviously asset price implications with higher level of inflation, let alone the real economy issues here. Frankly, I cannot see us going back to the pre-2022 days, before 2025, 2026. And I guess that highlights even more the need for more thoughtful inflation-oriented allocation. By the way, all this work actually started from an ask of a very large public pension. And that actually started, I can tell you exactly when the date was. It was the end of 2020. Believe it or not, it was somewhere here. Before inflation came up, they told us, listen, we're not sure exactly how this post-COVID is going to play out. At the time, yields were still at zero, equities were pretty high, but we are actually worried about inflation. Can we do an analysis and go back in time and look into inflationary regimes and see what assets are going to help us out? That's my view. I mean, it's hard to call the shots, right? I mean, if you take out last week, somebody would argue that the Fed is going to continue hiking. Now, it's almost as if last week had an implicit hike, and it's likely they're going to pause. So again, it's hard to call. It's hard to call.
Right. Okay. Obviously, that has. I mean, I can see why people are worried about the 40-60 benchmark portfolio and why people spend time on that. It is important. You know, the stuff that you sent the showed at the end. I mean, I suppose it shows clearly there that the trend portfolio will be quite a good hedge. Is that? Am I right? And I was thinking. Would you say the same thing? Yeah, that's right there.
Yeah.
Would you think that this is unique to the trend factor, or can you say the same thing about any multi-factor long short portfolio that one can create with momentum, value, carry, whatever? Is it unique to trend or?
So I mean the benefit of trend following as it regards down moves is that it's purely it's purely unbiased and opportunistic. It can go long or short any asset class, and the whole premise of it is that past moves effectively continue. There's obviously all sorts of academic reasons as to why this is the case. How human behavior interacts with with asset prices, and how central banks or commodity hedgers have their own utility function, which is not profit seeking, and therefore inflict serial correlation in the markets. But I guess to answer your question directly, we have seen trend following strategies offering what it's also called crisis alpha. But by crisis alpha, I basically mean performance in prolonged equity downturns. To put it differently, let's simplistically say the market is going up. If you're doing a trend following strategy, you're basically buying the asset. If the market corrects very abruptly, you're going to be caught off guard because you were long that particular market. So if the market correction is very sharp, trend following cannot necessarily do the job, as it actually happened last week. And that's precisely the impact we saw from the rates move, substantially impacting performance of trend. This is the contribution from rates into trend following, but also that's from equities down here. So either way you see it, if there's a flash correction, trend is not going to do the job. There are ways that we can make it more reactive and more responsive around turning points, but the benefit we see in trend following is when the market is going through a more macroeconomic driven recession. Examples here, since 2000, since the early 2000s, the worst years for S&P have been 2002. Can I actually share my Bloomberg screen or not? Do you want to do that?
Yeah, definitely. Yeah, you can do that.
Okay, let me do something for you then, since you asked the question. So, okay, let me do, because I was actually doing that last week for we're discussing with the client. So let me just take S&P, right? And now let me show you a seasonality graph. That's a very cool thing that they've done. So let's say that we're here. Can you actually see my screen well now?
Perfect.
Okay, perfect. So okay, so let me normalize the chart so that everything is like a growth chart, and let me go from, I don't know, sorry, let me just go from 2000, so the last 23 years, right? So this is the S&P, okay? These are the historical performances of S&P 500 over the last like 22 years, right? Let's look at the worst ones. This is 2008. I'm going to flag it here. This one is 2002. And this one, I hope it's last year. Yes, happy days, it's last year. So the three worst years for trend followers have been the dot-com, the GFC, and last year, right? Now, the COVID year wasn't, right? It was like a huge recovery. It was the fastest, or one of the fastest, to draw down in the beginning of the year, but then it ended up being well, right? So let me now show you. Let's get, that's a kind of a trend following benchmark that people use. Let me do the same analysis. Let's say the best years for trend following, and lo and behold, I guess you're seeing where I'm going to get to. So the best years for trend followers have been 2022, 2002, 2014. Sorry for that. I'm going to remove that. 2008. So these are the three, right? So is that coincidental? I don't know, Nikos, but there is certainly a dynamic here. Dynamic being that when the market is going through a phase of correction, trends become more prolonged. There is fundamental uncertainty that makes asset prices more serially correlated, and therefore a systematic pattern that allows you to capture those moves allows the overall construction not only to benefit from diversification across different markets, but also to capture those moves that human biases sometimes do not allow us to go in that direction. And by the way, and that's very, very important, it looks as if, oh, they've done the job in all those three markets. Reality is the drivers have been very different. Last year, so this particular one, the 2022, trend followers did well because there were short rates, short equities, long commodities. In 2008, they were exactly the opposite. There were long bonds, there were short equities, and short commodities. So that's the first quick answer. The second part of your question was whether investors can benefit from blending those exposures with with value or with carry. So there is an angle here which is primarily driven from the diversification element you can bring. So for example, you can say, hey, if I'm buying an asset that is going up, it becomes very expensive. So from a valuation standpoint, I should reduce the exposure. So when the market correction comes, I'm better behaved. Certainly it can help, but I would not necessarily claim that now we're building a defensive portfolio. I would possibly argue the more features we add in terms of, in terms of value or carry, that we create a more diversifying portfolio. If that kind of makes sense. So anyway, a long answer, but hopefully with the Bloomberg chart, I did.
Thank you, Nick. Thank you. I have lots more questions, but I will not ask them. I will let our student in the panel ask the question. So please. You can ask.
Yeah, thank you. Thank you for passing the floor to me. And thank you very much again, Nick, for being here with us today.
Sure.
It was really insightful with your content. So I have one question regarding the defensive trend following strategy that we mentioned on the first slide.
Yes.
So I didn't really quite understand, because we said that we will sell when prices go down and vice versa. So we will purchase securities when prices go up. However, in a bearish market, I guess all market participants tend to sell securities. Therefore, there will be a liquidity issue on the market. So I wonder, how is this trend following strategy applied, and how do we deal with the issue of market liquidity?
So very good question. So obviously market liquidity is a key driver of of how much we can actually trade. So I guess your question has like two legs, right? Leg number one is from a transaction cost perspective, and the second leg is whether the moves that we're seeing are marginal and therefore have no price impact, or potentially the coordinated fire sales are causing a further drawdown. Right, so I think there are two legs to it. So from a liquidity standpoint, the vast majority of the markets that trend followers typically look at, are your typical listed equity index futures, commodity futures, interest rate futures or bond futures, and then FX forwards. These are probably the deepest markets from a liquidity standpoint. Likely in a scenario of a down move, the bid offer widens, so possibly the replication costs become higher. But at the same time, if the trends are sustained, there is less turnover at the same time, because you're basically short. You don't have to rebalance the portfolio too frequently. Now, of course, where we sit and build those strategies, we spend a lot of time looking into liquidity, looking into costs, looking into smoothing the execution, looking into finding ways to reduce the impact of cost and turnover. But certainly, to your question, there could be a drag from a performance standpoint coming from from more expensive markets to trade. But reality is, because of the deep liquidity that you see in those markets, it is not really a big concern. Now, on your second point, or I guess the way I interpreted your question as a second point being, do CTAs or do trend followers or even volatility targeting can make a drawdown more aggressive? Here, the answer could be maybe. Maybe because if you're systematically selling when the market is down, and when it keeps on going down, you keep on selling and you keep on increasing your exposure, the more of us doing the same thing in a synchronous fashion, the more likely that we're going to have some sort of impact. Now, this is very hard to quantify that. And there's a lot of analysis actually run by a number of investment banks looking into the price impact that these type of systematic strategies can have. All I can say is that, in my view, the liquidity, based on some assumptions we can make about the overall industry, is deep enough to consume it. But equally, if you try and Google things like trend following, downturn, crowding, and so on and so forth, there are some claims around that. So, anything can make a down move more pronounced, whether that is selling because a signal is negative, selling because you have a stop loss, right? If you have a stop loss and you say, I don't want to lose more than 5%, guess what you're going to do when the price goes down by 5%? You're going to sell, right? Any risk management technique that scales, for example, by volatility. So if my volatility goes up, I'm going to reduce my exposure. Typically, volatility goes up when the price goes down. So if I start selling when the vol goes up and the price goes down, I'm going to make the price goes further down. So there are all those kind of dynamics. And the question is how, from a design standpoint, and now that's basically our job on a day-to-day, how we can make sure that the portfolio has deep liquidity, A, to not incur costs unnecessarily, and B, have no impact. That's the prime objective we have, making sure that there's no participation whatsoever, above and beyond the marginal one, which I guess, with a number of academics being here, can attain to the fact that marginal participation basically has no impact on price.
But that reminds me a little bit about the controversy about the impact of portfolio insurance. So
Yeah,
the Lehman
exactly
and Rubinstein, this is pretty much exactly the same kind of perspective, and that we have. Does it have a price impact or not? And I guess the controversy is still alive about these questions. And then if you pile up all these kind of systematic move, then possibly there is something, or possibly not, because behind you have arbitrageurs that are going to benefit from the fact that others are doing things that may be considered as crazy.
Precisely. I mean, at the end of the day, it's about building an agent-based model, and it's about trying to see how trend followers would react, how risk parity funds would react, how volatility targeting funds would react, and that's the portfolio insurance, the vol targeting of it. Then you need to look into how these type of players estimate their volatilities, because ultimately you make the move because of the volatility as well as a signal for trend following. Then you need to look into not how much you hold, but how much delta you need to trade. So if I hold, like, let's say, I don't know, 10 units of equities and I need to sell 2 of it, it's the 2 that matters and the liquidity that is about to be absorbed by that, as opposed to the 10 that I'm holding. So it's about estimating ultimately what's that delta and comparing that to average daily trading volume. But that's bang on. That's portfolio insurance 101 and the impact it can have.
So I think we have time for our last question.
Sure.
Yes. Okay. So yeah, I was wondering, like, could you please share with us one of your biggest challenges as a systematic investor?
One of the biggest challenges, I think. Let me just see. That's a good question. I should probably have a lot. Let me tell you 2, right? From 2 different perspectives. Challenge number 1 is when you design those strategies, you have to be laser focused and extremely conscious of the possibility that you data mine, right? It is the largest concern I personally have, and every time I speak to the team, and we kind of gather together to discuss the research results, that we acknowledge the possibility of this parameter actually being now a data mining exercise, and what we can do to make the design more robust. So the biggest challenge is building a culture among us, within the team, within the new joiners, within, I guess, the more experienced people, that we want to explicitly try to harvest and design what academically sound, what are the academically sound premia by the minimal impact of parameterization. That's one challenge, which is more on the design side. The other challenge, which I think is a good challenge, is when we speak to investors and clients. That's why I think the 2 are quite separate. One is on the design, the other one is like on the investor side. it's about working with the client. That's a good challenge, not a bad challenge. Working out with the client, what is the objective they want to solve for. In other words, some investor might tell you, hey, I want to be defensive to equity down moves. When equities go down by 10%, I want to be able to hedge myself. And then the day that the market goes by 2%, they started worrying, like, okay, when I'm not actually getting the defensiveness I was looking for. I'm like, exactly, because you did not ask for it. So because human beings counteract with objective functions, we spend a lot of time trying to distill what are we trying to solve for. Because if you try to design what you solve for and then you allow clients and investors internally and externally to manage stakeholders in terms of setting expectations, managing the expectations, and actually monitoring the expectations, I think you end up having the best outcome. But that's a good challenge for us. That's all.
Thank you for sharing that with us.
Thanks a lot. Nick, I also have a question from the crowd. And someone is mentioning that the fact that positive correlation between bond and equities is not from last year. It dates back to some years ago, and due to the Fed doing what it has been doing. But people didn't worry about it when it was in a positive market. So there are these kind of shift in regime, and they say, well, that's fine, because we're on the upside. And now when we go in the downside, say everything's looking at what's going on. But it has happened some times ago. So the question is that I think it's also related to how investors behave. They look at the upside, but sometimes forget about the downside or the risk of the strategies. So what do you have to say with respect to that?
I would possibly say that is actually a good question, because it kind of completes my statement a second ago, right? When things are good, we don't really care about too much the details, and possibly the correlation is positive or negative, then happy days. Reality is what happens when you're on the downside. So, the point that I would say is that there is a lot of career risk with investing, and ultimately, and I guess I'm kind of quoting again a bit more of academic work on the behavioral side. Our preferences are asymmetric to gains and losses, and and investor attention becomes much more, I guess, much more focused when things are good, and then when things are bad, you just follow sentiment. And I guess in this regard, I do not disagree with the statement that equities and bonds might have been positively correlated. But again, the question is, if it typically happens on the downside, that really happens more on the downside than on the upside, that's when it hurts the most. So yeah, it's a fair statement. It's a fair statement, but I think it's purely related to human nature.
Okay. Nikos, you're fine?
I'm sure, yeah.
So I think we could have spent an additional hour discussing together, Nick. I don't want to retain everyone more than that was initially planned. So I would like to thank you very much for this participation to the speaker series. The next one will be in 2 weeks' time, and that's going to be about machine learning and sustainable investment. And well, I'm waiting for you all here in 2 weeks' time with Emmanuel Jorzenko and another amazing speaker. Thank you very much, Nick. And
Much appreciated.
wish you the very best
you
for this tough year to come, I guess.
Exactly. No, thank you so much. It's been a real pleasure. I'm hopeful everyone enjoyed it. Thank you so much.
Yeah, definitely. Goodbye.
Bye-bye.
Good evening, everyone.
Bye-bye.
Thank you. Bye.